and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's guests are the ADMIS Research Team of Mark Bowman, Mark Soderberg, and JP Steiner. Starting with the grains today, Mark Soderberg, what is driving prices across the ag space this week?
Well, with last week's major USDA crop reports out of the way, I'm thinking some geopolitical events could largely shape a trade around the ag space this week, with the Trump administration now threatening European countries that oppose the U.S. complete and total purchase of escalating tariffs. The U.S. dollar has started off the week sharply lower. President Trump did state on Truth Social over the weekend that these tariffs will start at 10% on February 1st and increase to 25% by June 1st. Well, while the weaker U.S. dollar may be supportive for U.S. ag exports, the European Union is prepared to impose retaliatory tariffs of over $100 billion, which will likely include on U.S. agricultural commodities. So still much uncertainty here, along with the potential for high price volatility. And today, after passing on ruling on whether the Trump administration's use of tariffs were legal, not sure if we'll get anything from the U.S. Supreme Court this week or not. Nevertheless, there too, that's been kicked back now for a couple of weeks, so we get some sort of ruling here at the very beginning of this year. And of course, we're just going to continue to monitor the U.S. demand numbers. Reports are circulating today that China has now reached the 12 million metric tons of U.S. soybean purchases for the 25-26 marketing year. Now the market's just going to simply monitor the pace to these shipments. Also on the lookout for any new crop demand as well. So far, China has not acknowledged the Trump administration's claim that they have also agreed to purchase 25 million metric tons of U.S. soybeans over the next 3 marketing years, which happens to coincide with the extent of President Trump's second term. In corn, we saw record amount of ethanol produced in the most recent EIA data, so that does drive hopes for higher domestic usage. Also, there's a growing push for E15 to be sold year-round in the U.S. However, I think we're still a significant number of months or years away from a big growth in demand as a result. And of course, South American weather, mostly favorable right now, so I think we're going to continue to see higher production estimates from down in South America.
All right, thanks, Mark. Can you provide a quick rundown of how traders are positioned in the ag markets?
Yeah, last Friday's CFTC report did show a healthy amount of selling in both corn and soybean futures. In corn, they sold just over 65,000 contracts. This drove their short position back out to about 82,000 contracts. In soybeans, they sold 45,000 contracts, and now they've been net sellers now for 6 consecutive weeks, pretty much taking their long position, which was nearing 230,000 contracts back in the middle part of December. Now that has fallen to only 13,000 contracts. There were modest buyers in the soybean products and in the wheat futures. And then also, you look at the index funds, we did have a week of some reallocations from a major index fund. They were net buyers in the feed grains, while modest sellers in the soybean oil contracts.
To what extent can the latest round of cold weather affect U.S. gas supplies?
So we did see a sharp rally this morning, early Tuesday. Market gas reached its highest level since last year, December 31st. It seems like winter has finally arrived. Got a 6 to 10 day forecast with much below normal temperatures over the eastern 2/3 of the lower 48. And the 8 to 14 day has that pattern continuing into early February. Perhaps not as extreme. The west is above normal, but this week is cold. We've got temperatures down below to -4 in Canada, the -30s in the northern plains, sub-zeros across the Midwest, and all the way over into the East Coast. Now, last year we saw when winter weather finally arrived, we did see storage finally start to slip. We had last week's storage report up 70 billion cubic feet from the same week last year, and 160 above the 5-year average. But then last year it slipped below year-ago levels right around the third week of January, and eventually it went to 627 BCF below year ago by March. So, and it stayed that way all the way out into September. So it did seem to make kind of change the balance and give the situation in the U.S. a chance to come back to maybe closer to a normal level as opposed to being oversupplied. So I think this could happen similar this year.
All right, thanks, Mark. Switching over to softs, what are the ramifications of recent cocoa grind numbers?
So we had the latest numbers on last week. They were for the fourth quarter of last year, and the European grind, which is the one that's most looked at, was down 8.3% from a year earlier to 304,470 metric tons. This was a bigger decline and a 4.8% drop in the third quarter. And it was also a lot bigger than expected. There was, according to a Bloomberg poll of traders, the trade had been looking for a 3% drop. And this sent the market on a sell-off. This is like, okay, truly demand was damaged by the high prices when they see these numbers continuing to come in below year-ago levels. They also had Asia grind last week, which was down 4.8% from the same period last year at 197,000 tons. And the North American grind, the only one of the three above year-ago levels, they're at 103,000 tons, which is up 0.35% from the same period last year. That was the second straight quarter that North America was above year-ago levels, but the fourth quarter increase maybe not as impressive as a 3.2% increase in the third quarter. And this was followed by some Ivory Coast grind numbers this week. Did show for December, they're up 3.6% from last year, but today that was not enough to stem the selling. Their year-on-year cumulative grind is still down 9.2% from the same period last year. We're still seeing good weather in Africa, West Africa. No threatening weather in recent weeks. No reports of a strong high mountain wind damaging the crops. Maybe a little concern about some wet conditions, but they may slow the harvesting. There may be some possibility that some disease concerns will develop, but on the whole, it looks like it's a pretty good setup for a pretty good crop.
All right, thanks, Mark. And lastly, JP, what will drive price direction in the currency market this week?
Long story short, it's going to be political headlines. We have gotten off to a rocky start so far this week after trading resumed in the U.S. following a long weekend. The U.S. dollar index has seen a steep drop. It's fallen nearly 1% in trading earlier this morning as political headlines drive price direction. There is some economic data on the calendar for the U.S. and other countries like the U.K. this week, but those releases could see muted reactions as markets instead focus on geopolitical headlines. U.S.-Europe tensions are under the spotlight again after President Trump threatened several NATO allies with tariffs in a deal to get Greenland under U.S. control. The move is unprecedented, and markets are reacting accordingly with a strong sell-off in the U.S. dollar, bonds, and equities all taking place as a result. This is also happening as world leaders gather in Switzerland for the World Economic Forum, where the president will also be meeting with several allies to discuss the developments. As such, any headlines and related sentiment regarding those talks and demands from the president are likely to dominate price direction. Looking away from politics, pending home sales data Wednesday, followed by weekly jobless claims, PCE inflation, and revised third quarter GDP data Thursday should shine a little more light on economic momentum in the U.S. And also on how prices have continued to react as the economy settles into post-tariff reality. The PCE data, though, for November should help adjust timing expectations for the next interest rate cut from the Fed. Although the data is a little backwards looking, it still is going to be helpful for money markets. The first rate cut right now is being priced in for July. Across the sea, there is little data out the Eurozone, but there is some good data for the UK, which will be or should be pretty influential for the Bank of England. Inflation data out tomorrow is expected to show a slight bump to 3.3% after falling to 3.2% in November. Jobs data out of the UK this morning was, at a headline, not very good, but in a positive for officials at the Bank of England, there were some underlying details that were welcoming for policymakers there. The jobs report showed that redundancies fell while vacancies and the unemployment rate stabilized, along with the inactivity rate falling. Wage growth, which is a key metric for the Bank of England, also slowed. Now, that does sound worrying for the economy as a whole, but that easing in wage growth should help cool some fears over persistent inflationary pressures as the bank looks and sometime in 2026. Bank of England Governor Andrew Bailey did say he does expect inflation to reach 2% target sometime later in the year. So an update on that tomorrow will be keenly watched by markets.
Okay, JP, last final question. What are the implications for the bond market regarding Wednesday's Supreme Court hearing?
Yeah, so tomorrow the Supreme Court will hear arguments over whether or not the president can fire Fed Governor Lisa Cook. The case's implications stretch far beyond Cook's job. Markets are worried over the central bank's independence. That's a narrative that's been in the spotlight for quite some time now, and really nothing new. No president has attempted to fire or remove a Fed governor in the central bank's 112-year history until President Trump tried to do so in last year in August over mortgage fraud allegations. The case is ultimately going to determine whether the legal protections Congress created 90 years ago are going to insulate the central bank from political pressure, whether those have any meaning, or whether or not the president will be able to remake the Fed's board. So far, every living former Fed chair has urged the court to side with Cook, underscoring the severity of the case and its implications for the bank. Now, the hearing is also coming after Chair Powell was recently served a subpoena regarding his testimony to Congress over the bank's recent renovations. The case is important because of the Fed's so-called independence, which is its ability to set interest rates without White House control, has really never been a matter of law. It's no secret that the president has been pushing for lower rates, and many view his recent actions against members of the Fed as a way to implement control over the bank and lower rates. Now, bond markets are very worried about the ruling. So far, after every major news headline we've seen regarding these developments between the Fed and the White House, at least those of which have been tied to the bank's independence, we have seen a steep sell-off in the treasuries as markets react negatively to the news. If Cook ends up getting an unfavorable ruling, questions to the natural level of interest rates certainly going to start to arise, and worries that inflation could get out of control are likely to heighten. That could see treasury yields shoot higher despite a Fed that could be lowering rates. Investors very well could lose confidence in the bank's ability to meaningfully fight inflation as well, as a result of which could lead to a lot of market turmoil.
All right, thank you all. Remember, the views and opinions expressed here today on this video are solely those of our guest speakers and should not be construed as investor services or ADM. If you would like more information about our brokerage services, please visit ADMIS.com. Thanks again. Bye-bye.